Hey guys, thank you guys all for coming today. So, quick announcement about lunch. It's still coming. It's just slightly delayed, so we'll go ahead and get started with the presentation first. And today we have Gary Gensler. He's a senior lecturer over at MIT Sloan. So hopefully you guys will be taking his class next semester or next year, etc. But also, he's the perfect guy to be talking about blockchain and blockchain finance, because he's also a senior advisor to the director of the MIT Media Lab, and he is also currently, so 3 roles, lecturer, senior advisor, and I believe the chairman of the Maryland Consumer Protection Commission?
Yeah, something like that.
And prior to that, he actually worked under the Obama administration as the chairman of the CFTC, where he actually reformed the $400 trillion swaps market. So definitely he's got a lot of finance and technology background under his belt to be sitting here today. And I'm sure there's a lot more.
No, thank you, Kenny. No, thank you very much. I'm also a father of 3 daughters, and that's my main job. So thank you. I'm honored that you would all get together, and you're even here, and you don't have free food yet, so I get it. You know a little bit about me, but I know little about you. So without sort of taking all the time to go one by one, but just tell me, are you mostly Sloan students, or where so it's a yes. So how many of you are in the Sloan MBA program? Oh, I see. Okay. First years mostly, or? Okay, and maybe half and half in some are, and some I recognize are in the class. How many of you have ever owned a cryptocurrency? So, about half of you. How many of in your ownership of that cryptocurrency have actually gone and downloaded the nodes and hold that currency directly on what's it called, on the blockchain itself? 1, 2, 3, 4. Wow. Oh, what's your name?
Marjani.
What's that? Marjani, a little bashful about it, but you did. You downloaded the nodes. Wow. And has anybody owned something other than Bitcoin? You know, all right. So we've got some engaged, and you're all members of this club in some way. All right. So I thought that I would take, I do have some lecture slides. Let's make this interactive to the extent, because I couldn't tell, I'm doing a lot of public speaking on this subject these days, and I couldn't quite tell where to gauge, where you wanted me to take the conversation. So you say, heck, we know that, move on, I'm glad to do that. I'm basically somebody that spent my whole life around finance. I was at Goldman Sachs for 18 years. I was in the Bill Clinton administration. I did the CFTC gig. In the Bill Clinton administration, I was at the Department of Treasury as Undersecretary of Domestic Finance. I helped Paul Sarbanes write something called the Sarbanes-Oxley Act about accounting and reforming accounting. I've written books on personal finance. And then I did end up as on Hillary's 2 campaigns. We lost, I know. Why would you talk to me? But I was her chief financial officer, so I know something about being a chief financial officer. And my last job at Goldman Sachs was co-head of finance, where we had to help fund a $250 billion balance sheet and make sure that 1,000 people who were traders who could commit the firm's capital in 700 legal entities didn't blow up the firm in some way or another. So risk control is something I spend a lot of time around. This semester, I'm teaching a blockchain and money course, and I recognize 2 or 3 of you from that course, and you're really gluttons to come back and hear me speak about this a little bit more. So let's just dive in a little bit, and hopefully have some fun with this. So I thought I'd start with a little bit of a summary as to what I want to chat about. Am I in front of all this? Do I have to maybe help us out? Sorry.
Yeah, that's fine.
If you're trying to film. I've just decided to move my engagement here. But blockchain technology basically verifiably moves value and applies computer code. So just think about that. We have a network, we have the internet, and blockchain can do 2 things. Verifiable is a key word we're going to come back to. But verifiably moving something of value we happen to call it money, but something of value, and it applies computer code. We're going to dive into all these. This just so you've got a chance to know where we're coming. Come on in. Come, please. Welcome. The tie and jacket. Interview
Gary,
day.
will you share the slides with us from the club?
I'm sorry?
Will you be able to share these slides with us from the blockchain club?
Glad to share the slides. Thank you for asking. Finance at its core moves money, but I would say allocates money and prices money. So any of you masters of finance or on the finance track? Yeah. So finance at its core basically intermediates or stands at the center in a sense of the economy and moves, allocates, and prices capital, money, but also risk when you think about insurance around the economy. And thus blockchain technology really goes to the plumbing. And the plumbing is not the sort of hot or sexy part of finance often, but blockchain technology fundamentally goes to that plumbing of moving and allocating risk through our economy. Finance over centuries has had issues. I'm not just talking about the 2008 crisis, but it's always had issues because it concentrates risk. When you take a lot of risk, you put it in one place, sometimes it spills out. And truly, any study of history of humankind would tell you that at the center of some economic and other crises are not just droughts and things like that, and famines, but often it's also about financial crises that have happened throughout history. And some of it is the concentration of risk, but we'll chat about some of the issues as well. But I believe blockchain technology can be a catalyst for change. I, by the way, am not a blockchain maximalist. I'm not all the way over on the side that said it's going to change the whole world. But I caution, if you're going to stay with me for the next half hour, 45 minutes, I'm neither a full minimalist. I'm kind of in the middle, but then you can decide. You're all Bitcoin club members, so you're probably a little bit, on a 1 to 10 scale, you're probably center maximalist to full maximalist. I'm not quite there with you. But I think it can be a real catalyst for change. I think that the actual blockchain technology underlying Bitcoin for real adoption and even adoption for cryptocurrencies is that we've got to address a whole bunch of technical issues that are not yet addressed. And it will probably take single-digit years, not single-digit months to do that. But I think it is in that, whether it's the 3-year or 7-year time horizon, but that a lot of those technical challenges. We've got to address some commercial challenges. Right now, there's not big use cases for this technology, and address some public policy issues. But I do think investment will come. So now we go to the fun stuff, the role of money. Anybody want to tell me what the role of money, who's not in my class, I see a smile here. You know?
Thank you.
Benjamin, what's the role of money? There was no readings, I'm just having a little fun here.
Yeah, is it to be able to purchase goods?
You can purchase goods, all right, so that's called a medium of exchange. Anything else?
Relocate.
What's that?
Relocate.
Allocate?
Relocate.
Relocate.
Yeah.
Oh, so you and I can relocate and move, so you can use it for something. So the role of no hands, all right. All right, so 3 things. Medium of exchange. Oh, back here, was there a hand?
Oh, I was just going to say to communicate information about value and scarcity of goods.
Right, so it's a unit of account in that way. So there's 3 things that the role of money. It's a medium of exchange. You can use it. You can think of, we moved from the barter system, and then you could start to use something to buy those goods and services. It's a store of value. Once we came out of this sort of an agrarian society, but I'm talking about thousands of years, you could actually keep some of whatever the currency was, gold, silver, or even prior, and store some value. And then it's a unit of account. These 3 social constructs, unit of account, store of value, medium of exchange. The role of finance. I've already sort of said this. I've already shared my views about the roles of finance. but it moves, allocates, and prices. So moving around an economy, in a sense allocating a scarce resource, and pricing money and risk. It's a much more complex thing. It takes 7.5% of our economy to do it in the US, and in many economies it's between 5 and 8%, but in terms of finance, in the US that's $1.5 trillion of revenue. I mean, that's a lot of shekels. But finance and technology have all lived symbiotically over a long period of time. And we're going to talk a little bit about that. So blockchain is just the newest of something that might change finance, but it's not the first. So a little journey on money. Does anybody know anything about cowrie shells or the salt bars of Ethiopia? Do you think that this would make really good money for long term? It's not terribly durable, but it was scarce. Salt in Ethiopia is kind of scarce. So there's different qualities and different characteristics of money, and one is durability, one is scarcity. Because if it's not scarce, it's really hard in a sense. In England, they used tally sticks, and this was an account-based form of money. These notches on the tally sticks actually meant basically something about credit. And these wonderful stones in the island of Yap, near Indonesia, sort of the Indonesian chain, until the late 19th century was used for money. Just to give you a scale, a human is about this size. So these are not small, but they were exceedingly rare because they were quarried from an island over 200 kilometers away. And they were a form of money because there was a social construct amongst the thousands of people living on the island, and it was not hundreds of thousands. They trusted each other, and they didn't even have, they said, I'm giving you my 1/100th of this Yap stone. And they would do it verbally, and the Yap stones could sit anywhere. One was lost for a long time, it was in the bottom of a river, the Yap stones. Why is that relevant? Because it's a lot like current fiat money. But we've also had metal money. Early technology in Rome, they didn't even mint it. But then later, if I get my Rome gold, they were ever mined. And the characteristics of these money will bring us all the way to Bitcoin. They were scarce. It was hard to mint and mine. And we know from the half of the class that uses Bitcoin that there's a mining aspect in Bitcoin as well. They were divisible. Gold was really good, much better than salt because it was durable. All the world's gold that's ever been mined is largely still here, hundreds and thousands of years later. So it's a remarkably durable metal. But then we started to use paper money. And the earliest paper money, this is from about 700 years ago in China, the earliest paper money was taking commodities, putting them in a warehouse, and issuing a piece of paper that said behind it there was something in the physical warehouse. They were called warehouse receipts, and to this day there are still warehouse receipts. That you can transfer wealth and value by transferring warehouse receipts. But it went on to sovereigns started to say, hey, I can do this even better. This is from the 18th century in England and the US. And then private sector said, wait, we can get in on this too. We could issue paper money, and there's private sector banknotes. And of the 1,500 or 1,600 different cryptocurrencies, many of them are really like private sector banknotes in a way. So we build upon this heritage. Now, what's fiat currency? Does anybody know what fiat currency is? Benjamin?
It's a government-backed currency.
Government-backed currency. So when we think about the paper money, it's like the sovereign, the government said, we can put something in a warehouse, gold or other things, and issue paper. But what if we actually issue more paper than the gold. And over a couple hundred years, what if we just don't have anything backing it? It's just a social construct. Fiat currency has attributes. Of course, it's the liability of a central bank. Central banking started in the 17th century as a check on the sovereign. The King of England wanted to go to war, wanted to print more money. At some time, the noble lords kind of said, whoa, wait a minute, you're debasing this stuff, you know. But every country has a central bank, but you can think of it as a little bit of an unelected check on the elected part of government, or where they're not elected is still a little bit of a check on the sovereign. They have two things Bitcoin does not have. They're accepted by governments for taxes. In some countries, that's 50-60% of the economy. In other countries like ours, it's about a third of the economy. But that is a benefit that Bitcoin and cryptos don't have. They're not accepted for taxes. And under the law in most countries, they're accepted for all debts, public and private. So in the comparison between cryptocurrencies and fiat, two big advantages. And one last thing about accounting. Is anybody accounting, you know, CPA or anything? No. A ledger is just a recordation of transactions, a recordation of accounts. Money today all relies on a system of ledgers. When you go into Starbucks and you want to pay for something, what you're really doing is say, move something from my ledger at Bank of America to your ledger at Chase Manhattan. It's moving a digital representation of a store of value between my ledger and your ledger, or my bank's ledger and your bank ledger. And that's why actually cryptocurrencies might have some relevance. So financial ledgers over time, George Washington's ledger, but all the way back to cuneiform. The earliest writing was actually written records of numbers and ledgers. Who had the grain, who didn't have the grain, and so forth. By the time IBM came along, and I picked a seminal moment in the computing power, IBM came along in the 1960s and created the IBM 360. It was a significant, huge change. I mean, now we have these things. This has more computing power than the IBM 360. But when it came along, it changed the back office of banks and Wall Street. There was the paper crisis in the late 1960s. Wall Street actually literally had to shut down because they couldn't handle all the paper flows. There were some federal laws put in place and mandated some centralization of what was called the cage. Cages were physical cages where paper certificates were held. Yes, I started on Wall Street in 1979 at Goldman Sachs, and there was still a physical cage. 6 or 7 years after Congress had mandated everything had to go to a central repository. But the IBM 360 was a big change. When I started Goldman Sachs, they were still on old Burroughs mainframe computers. And that was a mess because Burroughs was not a great company and later failed. But bad tech decision of Goldman Sachs in the 1960s. Should have gone with IBM. Settlement systems, I mentioned, are a way to change the records. Settlement and payment systems. I go back and grab Thomas Jefferson's check, but that's just an instruction. Please change something from my ledger at a bank to your ledger at a bank. So what are the technologies affecting today? And if you're studying Bitcoin or blockchain, I just say put it in the context of overall technologies. We had some meetings, Andy Lowe and Sylvia McCallie and others over at CSAL, the Computer Science Lab, had some meeting with some finance executives recently. And when they went through some of these, AI and machine learning is much more on their minds than blockchain. I'd say for most of them, this was about third on their list. Some it was fifth or sixth. Some it was first, but it was rare. I'd say that the key focus on their like wish list, my favorite chatbots I wish was lower. I personally am not a great fan, but it's a huge efficiency gains with chatbots and how to take a bit of machine learning and voice recognition and so forth. So I just put the technology in the broader context of what's called fintech as well. So I said that I'd mention the finance sector opportunities. Finance has a lot of legacy systems. It's got a lot of weak data interface and user interfaces. It's got crises. 1.7 billion people around the globe are not in the banking system. Now, in modern economies, you might say, well, wait, there's less opportunity, more people are in, but they might not have good accounts, they might have to pay a lot for it. And a big thing is there's a lot of economic rents. There's a lot of excess profits in finance, because as I mentioned, it takes 7.5% of the US economy. Now, you all might actually want to be on the other side of economic rents, because every good entrepreneur wants to ultimately collect economic rents. That's excess profits, in a sense. Right? Every good startup one day wants to aspire to be a monopolist, but in the meantime, you want to attack the incumbent and take some of their rents away and capture it. And finance has a lot of what I would call excess rents. So, Satoshi Nakamoto. Does anybody know who Satoshi Nakamoto is? Oh, good. Yes. Solve the riddle. All the world is watching. What's your name? Adam. Who's Satoshi Nakamoto?
So the riddle is actually
Oh, Adam.
I thought you went who was the myth was, or who the.
All right. Does anybody know who Satoshi Nakamoto is before Adam tells us about the myth? All right. All right. Please tell us about the myth. I'm not disappointed. I was just hopeful that you could solve the riddle.
I mean, there's some people who claim to be him. I think there was an Australian guy who somehow managed to sign a document showing.
Right. So who is the myth?
So he is the originator of Bitcoin. He was the one who first published the RFC for Bitcoin.
Right. So on Halloween 2008, Satoshi Nakamoto, she or he, right? She publishes this. This was the first sentence of an email put out on a cypherpunk mail list. That's a word, I didn't make that up. But, and that cryptographer's email started with a very modest thing. I've been working on a new electronic system. It's fully peer-to-peer, no trusted third parties. Peer-to-peer movement of money with no central bank, no central authority, a new form of money in the middle of the financial crisis. A lot of folks had tried to do this. All through the 1990s, people had tried to create a digital cash that was somewhat similar to the internet. The internet is decentralized, it moves packets of information around the internet without, in a sense, a central authority. Now, I could exaggerate and say the internet has no central authorities. It does, in a sense. There are foundations, nonprofits like ICANN and sort of the are behind. But there's no central movement. The data packets move around the network. Satoshi Nakamoto sort of solved that riddle. And so what is blockchain? I'm going to have three things to sum it up. Append-only logs. I use little blocks, but think of this as a block of data, a block of data, a block of data, block of data, block of data. This was an invention in database management from the early 1990s. Two Bell Labs scientists created a way to keep data in blocks of information that are connected through cryptography. And the words append only means that you couldn't go back and amend an earlier block of data. Early 1990s invention. And it used cryptography basically to create a database. And you don't have to remember a lot about cryptography, but cryptography has been around for thousands of years. And it was basically to protect communication in the face of adversaries. Think about generals in Greek and Roman time trying to get a command to their troops. That's the earliest form of cryptography. Think about the Germans' use of something called Enigma, which had these whirling rotors but it's basically a mathematical puzzle to encrypt messages. If any of you have seen the movie Imitation Games. But modern cryptography really took off in the 1970s and 80s. Some of it right here at MIT, like Professor Ron Rivest, who still teaches here, created some of the most remarkable things in the 70s and 80s. It was so remarkable that the US government initially said you couldn't actually export this intellectual property. Now what we take for granted in something called hash functions and digital signatures, initially for the first 20 years were like trade secrets. But then it got published and it's out there. Cryptography is used every single day when you go on the internet. Every day when you go on the internet, when you purchase something. But Satoshi Nakamoto combined it with saying there's no central authority, and he created a consensus mechanism called proof of work, or Nakamoto consensus, to say there is no one party that's going to put the block of information on this. So it's a database system that's append only. It uses a bunch of cryptography, but the two main things are hash functions and digital signatures. But there's no central authority. And so it has to have some form amongst people that don't trust each other. Do you all trust each other? Come on, you're all in a class together. What's that? You're Kenny? You said no? Right, you're competing for jobs, you're competing for interviews, you might be competing for attention, for a teacher's attention or something. Right? He figured out a way to say, we don't need to trust anybody else. I'm glad to take a question on that, but let me talk about blockchain economics. And this is like, we're slow and you gotta talk about economics. If somebody's coming to you with a use case to use blockchain technology or use a cryptocurrency, be very careful not to say, oh, just because it's got a cool name, blockchain, we've got to use it. And there's two buckets of the economics. Does it lower the verification cost on data? Does it lower the verification cost? Does it address privacy costs? Does it address censorship costs? This is all a bucket of verification costs. Ultimately, the cost of trust. Christian Catalini, who works at Sloan, has written a lot about this and is really at the forefront Christian's work on that. But verification costs. And secondly, does it help you jumpstart a network? Could you create Uber today where the drivers got paid more than 50 or 60% of what the riders are paying? Like Uber, the app, takes the VIG in the middle, 40 or so percent. Now they might say it's 20 to 30, I might be mistaken, but I think it's about half. But could you create a decentralized Uber on this technology where the riders, the owners of the cars, and the drivers kind of shared in that economic wealth, and there were less economic rents, because Uber now has a bunch of economic rents, but they're collecting those economic rents because they somehow jump-started a network. Uber would not be valuable today if you didn't have an ability to come into Logan Airport and know that you hit your app and there's hundreds of cars that might be lining up. There's huge network effects that they've figured out. Here are some of the financial sector use cases that have been kicking around. None of them are production ready. And I think that many will not be production ready for years. I mean, this is just, but some of them that you can peruse. In the class I'm teaching, the final project is to come up with a use case and try to pitch the professor, so to speak. Yes?
Can you clarify what production ready?
What's that?
Can you clarify what production ready?
So, there's a lot of, what, the question is, can I clarify production ready? There is no blockchain project in finance that's being used at scale. There are enterprise applications that are far along, but they're not in use yet. The Australian Stock Exchange is trying to use blockchain technology in a closed permission system for all of their clearing and settlement, for instance. And there are hundreds of projects like the Australian Stock Exchange, but they're not yet gone live. There are permissionless systems, and the highest use is about 1,500 uses a day. But most of them are like 100 to 500, literally in the whole world, the use of an application. So they're very small scalable. And those are like something called crypto kitties, which is collectible digital cats. Or they're gaming sites or gambling sites, but they don't have scale. So does that answer your question? So some of the challenges are these performance. Bitcoin moves about 7 transactions a second. Ethereum network is similar, single digits per second. Visa is 25,000 transactions a second. The clearing mechanism in the U.S. Stock Exchange, DTCC, the Depository Trust Corporation, that was set up in the 1970s to clean up the paperwork mess, has to be shock tested to do 100,000 transactions a second. Now, they don't normally do that much, but they need to have that capacity, that flow, and that really short latencies. So we're not there yet. My own view is single-digit years, we will solve most of these, whether it's at great institutions like MIT or elsewhere or commercial. Interoperability, meaning systems talking to each other, kind of, is a little harder. The hardest thing will be governance and collective action. What I mean by that is, how do you make a decision either for a software update or anything? How do 60 people in this room make a decision collectively as to which bar to go to tonight? And we all know how hard it is when your friend says, I want to go to this bar, and somebody else says, I want to go to that bar. And you start texting each other, and where are you all meeting up? And if you don't drink, it's just, but that's a collective action issue. In a distributed, decentralized network, there's a trade-off. So I think of some of the economics this way. What are the costs of centralization versus decentralization? Centralization, this is a cost. Centralization has capture. It has rents. A monopoly can capture a lot of excess profits, and it's a single point of failure. Also, centralization often is a little slow, sleepy, and not innovative. But decentralization is damn hard to coordinate, and it still has scalability and security issues. So from the raw economics, now, if this slope came down, you'd be somewhere over here. And if you're a Bitcoin maximalist, you believe in this end, you probably believe this curve needs to come down and this curve needs to go up. Just pure math. But a bunch of incumbents want to get into this space. A bunch of incumbents like the lionist in the corner want to get in. It's a $200 billion market. But the worldwide equity markets are 80 trillion. The worldwide debt and bond markets are nearly 300 trillion. So 200 billion is juicy. It's got a lot of volatility. Fidelity announced Monday, I was at this small conference where they rolled it out on Monday. Fidelity has 26 million customers, and they're announcing they're starting an institutional blockchain business where they're, and crypto. They're going to support institutions, family offices, and hedge funds that want to invest in crypto. Fidelity is going to start supporting that. So the incumbents want in, which kind of tells you can't be fully a minimalist. Yes?
Do you know when that's going on?
I gave the intro, not to them, but I gave the keynote, and then they did their thing. So I apologize if I was only like half listening. But I think that they were talking about that by the first quarter, they're starting with custody. Their main first thing is, there's a big custody issue. So the 40 or so of you that said you had Bitcoin, what was there, 3 or 4 that said it done it right on a blockchain? So anybody that's done it on a blockchain, where do you store your private keys? I'm not looking to steal your private key. Where do you keep your private key?
In split between a safety deposit box and my parents' safe.
All right, so you keep it somewhere in in a cold storage, printed on a piece of paper probably, in some safe place. But this custody issue, this digital signatures, and the store of value ultimately comes back to what's in cryptography called a private key. An alphanumeric 64-digit type of thing that most humans can't remember. And the ultimate cold storage is in your head. But then what if you pass away? Then it's gone. Some people think that Satoshi Nakamoto is somebody that is no longer alive, and that the private key is gone. But Fidelity is starting with custody, how to store private keys, and they think that in the first quarter to second quarter, but I think it was first quarter of 19.
So they're starting with custody, but not necessarily allowing transactions.
So the Fidelity service is going to be, they're not standing up a crypto exchange, but they're starting with custody, and then exchange services, where they can provide services for institutions. It's not retail. So it's going to be institutional custody and institutional exchange services where they can order route to the exchanges. I think that's just a half step away from them actually having an exchange function and having exchanges have several features, but the key thing an exchange has is a matching engine, matching buyers and sellers in an algorithm. All modern exchanges are digital. But I think they're starting with an exchange services rather than having the matching engine itself.
And you're the first to do this in like I say, major financial institutions?
Well, Intercontinental Exchange that owns the New York Stock Exchange has announced a startup called BACKT, B-A-K-K-T. And those who are in the class I teach are going to have the CEOs of BACKT and the Intercontinental Exchange speak to us in November. If there are rooms, some of you are invited, but I think it's going to be a little tough to accommodate all of you, plus the 80 or so students in the class. But welcome to stand in the corners. So Intercontinental Exchange is definitely an incumbent that's in this. Fidelity, the Chicago Mercantile Exchange has Bitcoin futures. So I wouldn't say they're the only incumbent, but they're each of the incumbents are finding different ways to tap into this $200 billion. Does that help?
Yeah.
But many incumbents aren't. BlackRock, a $6 or $7 trillion asset manager, currently is not, for instance. It doesn't mean that Larry Fink isn't having somebody study it and think, okay, is this something for 2020 or 2019? Some of the challenges, I'm not going to go through this list, but here are some of the challenges for investors. But the key challenge ultimately is, what is the viability of the token? If you want to invest in a token, at some point you have to say, is it only a store of value? Is it digital gold, as Nathaniel Popper wrote about Bitcoin? Gold has 3, 5, 7,000 years of history and social interest. Gold collectively is about $7 trillion of value, the collective world stock of gold. But it has 3,000 or 5,000 years of history that gives it a social construct and meaning. But is it just a digital gold, like maybe Bitcoin is? But if you get to the 1,600 other use cases, you better sort of say, what's the viability of the token? Does it lower a cost? Will it be used? And so forth. I'm conscious there's lunch out there, so I might finish in 1 or 2 slides because you want to get that lunch, right? Am I Ben and Kenny or others, or should I finish this little thing? I should go ahead? Check. All right. So, public policy. There's 3 slipstreams of public policy that people really care about. Let's guard against illicit activity. Let's make sure this doesn't topple the financial sector, and some investor protection. And I'm talking about Bitcoin mostly and Ethereum. But the U.S. Department of Treasury and most Treasury and finance ministries around the globe started right up here. They didn't want to lose a tax base. No official sector really wants to shrink their tax base. meaning having, less taxes, less revenues in a sense. And they don't want illicit activity, money laundering and the like. It's really hard because whether it's Bitcoin or others, while the blockchain is public, it was easier to hide illicit activity. Around the globe, 180 jurisdictions, most agree we want to guard against illicit activity, but it's a really hard thing to pull off. Crypto finance, this $200 billion market, has been a new way for, crimes aren't new, criminals aren't new, but there's a new technology. They move to the new technology and they try to exploit it. Criminals are still using bags of cash. $100 bills and 500 euro notes are still a really preferred mechanism to do a lot of this stuff. But there are now literally people that will take thumb drives and meet in dark places in the woods on, the Finnish-Russian border or something, and and exchange thumb drives that might have the private key of some Bitcoin for bags of cash. And there is a marketplace even for that. And so it's a new way, but it's not the only way. Investor protection, which is the bottom rung, it's all over the lot. I'm going to keep going because we don't know if the food's there.
So good news is it smells good outside. Bad news is it's not ours.
Gosh. All right. So then I'm going to hit 3 subjects and then I'm going to wrap. Crypto exchanges, initial coin offerings, and central bank digital currencies. Crypto exchanges. Most of you that have owned Bitcoin have bought it on crypto exchanges. Can I ask if people are willing to say which exchanges have you used? Just a couple of examples. Binance?
Mm-hmm.
And what's your first name?
Julie.
Julie used Binance. Coinbase.
eToro.
Which one?
eToro.
eToro. Haven't heard of that one.
BitMEX.
So there's about 200 crypto exchanges. We just heard 4, but 200 worldwide. The vast amount of the volume's probably in the top 10 to 20, but we don't actually know because very few have any regulation whatsoever, so they self-report their volume. It may not be accurate, but if you can make more money by projecting that you have big volume or lots of members, there's going to be some fraud here. It's human nature. By the way, Bitcoin does not repeal the human nature that some are going to be, good faith actors, and some are going to be right on the borderline between good faith and self-promotion, and some are going to be just outright fraudsters and liars. But in that spectrum, we have 200 exchanges. And so some of the issues. They're responsible, number one, for the vast majority of volume. Probably 98 or 99%. This is an unusual group. When I ask other places I speak to, Monday I spoke to 150 sophisticated institutional investors who were sitting there waiting for the Fidelity announcement. I asked, how many of you have ever owned Bitcoin? 2/3 of the room raised their hand. I said, how many of you have done it directly on a blockchain? And 3 of them, so less than 5% of the people that had owned Bitcoin had owned it directly on a blockchain. You're a younger audience and you're at MIT, so it's a higher percent here. These were sophisticated institutional investors, probably in their 40s, roughly. But the vast majority is on crypto exchanges. So there's an irony. In a decentralized technology, we're using centralized platforms. 30 million customers, they lack brokers accessing them. The custodial wallets, there's been billions of dollars of value hacked and lost. Lost, I say, but it's really stolen. Decentralized exchanges are creating issues, but the official sector, like I'm talking as a former regulator and a man of finance, but as a former regulator, I'd say this is the real gateway. I say to anybody I speak around the globe, to the OECD or other governments around the globe and everything, this is the way if you want to instill public policy. If 98% of the actions here This is a node to affect public policy, not a node on the Bitcoin network, but a node to affect public policy. That's where you want to go, whether it's tax policy, whether it's about illicit activity and money laundering, whether it's investor protection, right here. You always look in public policy, in a sense, for the gating issues. And by the way, if you're a business student, you look for gating issues to make money. Where's the best way to make money in a market? At the gates. Where's the information flow? Where's the traffic flow? I've spent a lot of time around politics. I've, in this latter part of my life, but I was at an event early on, kind of a, just call it a community bull roast type of thing. Hundreds, thousands of people are coming through, and I see the local elected leaders. Where are they all standing? Right at the front of the food line. But, you know, everybody. I go over to one of them. I said, you know, why are you standing here? He looks at me like I was so naive. Of course you're standing right at the front of the food line. It's where every constituent's got to walk. They want the food. Look to the gates. Look to the gates. If you're an entrepreneur, forget about this is a Bitcoin club. I'm giving you a lesson in like business. Look for the gates. You have more opportunity. If it's a gate for information flow, people flow to the food line like a politician. But in public policy, this is a gate. And at a gate, you have more opportunity because you have a lot of flow and you can affect something or make money or get votes. So then, initial coin offerings. Initial coin offerings are ways people have raised money. Vitalik Buterin did this to raise his $18 million in 2014, if I have my year right, for the Ether network. By 2016, somebody had raised $150 million in an initial coin offering. The concept is basically, I want to get proceeds for a network I haven't yet built. I'm going to build this network, but instead of selling equity to a venture capital fund, I'm going to sell a bunch of tokens that someday, hopefully, will be usable. It's a neat way to crowdfund, but it's also off the grids. $28 billion have been raised. There's a neat website called Elementus that this is actually the last bit of a 2-minute video. But EOS cleverly raised $4.2 billion over 350 days. They had a daily auction of their tokens. When they started, I bet you they didn't think they were raising 100 or 200 million. This EOS is to be competitive with the Ethereum network. But all of these are different raises. About 5,000 companies have taken out websites and published white papers. Over 3,000 have raised some money. Over half of that 3,000 have already failed. Some of the ones that failed were good faith actors. Some that failed were complete scams and frauds. And there's different studies about which ones are scams and frauds. But $28 billion is chomping away. Maybe only 15 to 20 billion is left, but is chomping away, trying to find use cases for blockchain technology, trying to justify the money they raised. And foremost, they're trying to enhance the value of the tokens they sold because often they still own tokens. So they have an economic motivation to try to enhance the value. Most will fail. The blockchain maximalist would say, well, just like the internet in the 1990s, most fail. But if you happen to hit the eBays or the Amazons or later the Facebooks, you made a lot of money with them. The minimalist would say they will all fail. And they will say that because they say there's no need for token economics. And at the core, that's an unknown question yet. I would say be cautious, minimalist. Gamers like to pay a lot for the swords and skins and the things in the middle of games. There is something about human nature that might want a token beyond the reasons of a store of value, a unit of account, and a medium of exchange. Back to the 3 central reasons we have money, but there might be something more about token economics. a reward system, an affinity system. How many of you have seen that George Clooney movie Up in the Air? Many of you? Do you remember late in the movie? I mean, Clooney, he's flying everywhere. And I'm not talking about the romantic interest. I'm talking about he's flying everywhere. But remember, he gets to 10 million miles. And it's a wonderful scene. He gets his card. There's something about that in human nature. So some entrepreneur is going to tap in to a sense of token economics, whether it's like the affinity points or the airline miles or the darn skins and swords in the games. So I wouldn't count this stuff out as the minimalists do. That's just Gensler's view. Last thing, central bank digital currencies. Central banks are looking, do I use blockchain to issue digital money? Central banks currently issue digital money. The US central bank, called the Federal Reserve, there's 9,000 commercial banks roughly in the US. Every one of them has an account with the central bank. That digital account is a form of digital money, and it's called reserves. It's a ledger, it's accounting, it's boring, it's plumbing, but it is still money with the central bank. The real strategic question is this: should access go more broadly? If you were in the US, instead of 9,000 banks having a digital reserve account, should the public have it? In Sweden, they're the furthest down the road, called the e-krona project. They're looking at it very closely. But there's a whole host of problems and challenges. Will it disintermediate the commercial banks? Will the commercial banks get cut out? Let's take the US for a moment. 9,000 commercial banks, one central bank. If the central bank says to 328 million Americans, you can have an account directly with us, some of those Americans are going to say, I don't need to go through the 9,000 banks to have my store of value, my medium of exchange, and so forth. So that there's a big fundamental economic sort of challenge of the business model of a multi-century thing. We've been having commercial banks for 300-400 years. And it's a really fascinating public policy thing at the end of the day. What happens if Sweden actually has this e-krona project? In Senegal, a West African country, they actually adopted a blockchain project where a commercial bank could issue I can't remember, it's not called e-lira. Sorry, anybody know the currency in Senegal? It's called e-money. Sorry, Senegal, I can't remember the name. But they said, we don't want to disintermediate the commercial bank. We've got to keep the commercial bank in this system. And there's a startup company out of England that was providing the software. So there's always a startup somewhere who's providing the software. By the way, 200 crypto exchanges, there is one software developer that has contracts with 100 of them that provides the same software to 100 of the 200 crypto exchanges. And I met that gentleman Monday. He came up to me, handed me his business card, and wanted to make sure that I knew about his company. And here I am 2 days later, he's been successful. I'm talking about his company. So there's a lot of centralization, and there's a lot of opportunity to make money, by the way, if you're that software provider into this field as well. Gosh, no food, and I'm all the way to conclusions. This is sad. Look, money is a social and economic consensus. We already live in an electronic age, as I said. The financial system's had some problems, and it always will. It's not going away. I mean, finance concentrates risk and collects economic rents. It doesn't have as much inclusion. That's a reality, and we'll have crises from time to time. It's part of human society. I think blockchain does provide a peer-to-peer alternative, and the key word is alternative. I don't think it's, I'm personally, I don't think it will supplant the whole thing, but it's an alternative. And it will let the best solution or use case win. I think it will do better if it's inside the public policy envelope rather than outside. But, you know, that will be, some people want to stay off the grid. Joe Stiglitz, a Nobel laureate, has said, the government will stamp this thing out. I don't agree with Joe. He's a personal friend. He's a good guy and everything. I just don't agree that it will stamp it out. But I do say this: they will not let it stay off the grid if it has any size. Everything at some point kind of comes inside a public policy envelope, and then you change it. You change. The internet came along. We have to change rules and regulations and laws. Is it taxed? Is it not taxed? And so forth. Are there liabilities? But I think it will come inside. I think a lot of the technical challenges will be addressed, but we're not there yet. We're years, single-digit years away, not single-digit months, I think. And if I'm wrong, it's longer. I don't think this will happen fast. So those are my thoughts. I teach at 2:30 to 4 on Tuesdays and Thursdays. I'm probably going to teach it again next year in the fall, if you want to take it. I do teach, it's a shameless of me, but I'm saying I teach a public policy and private sector course in the spring with Simon Johnson. So Simon and I on Tuesday nights, I think it's going to be from 5 to 8. So it's once a week. It's kind of curated guest speakers. I mean, we stood up in the spring. We had a fun time. We had speakers like John Podesta, and that was kind of fun. But we had some speakers. But the concept there is, you're at a business school, is it relevant to know a little bit about what happens in Brussels and London and Washington, and how to invest around it, and at times even how to influence it. I mean, so it's ground truth, just like this blockchain course. I hope this is helpful. I'm sorry there was no food, but that's not on me.
So want to give Gary a round of applause.